This Fireside Conversation is with Dirk Steinhoff, our group's Chief Investment Officer. I've worked with Dirk for over 15 years now. He's a key pillar of everything we do at BFI, and I always appreciate his analytical and matter-of-fact insights when it comes to investing. In this conversation, we provide a bit of an outlook for investors in 2024. Dirk shares his views on which sectors to focus on, how supply shortages may impact commodities, where we see inflation headed, and how geopolitical tensions influence our considerations, and much more. I hope you like this conversation, subscribe, and enjoy this interview. Dirk, welcome to Edmatingen. You know this office well. You worked here for a long time. Now your office is in Zurich, so 10 minutes from here.
Nice to be back.
But it's
memories
good.
coming also.
Good to have you here. So before we get into a bit of an outlook and maybe also looking back to 2023 a bit, how has your year started this year? How are you doing?
Oh, that was great. I mean, first, as you know, I'm from Germany, I'm from Berlin, and my family was visiting us over Christmas time, so that was very nice to spend time. And after that, we went skiing. I mean, Switzerland is such a nice country and offers so many opportunities.
Do your parents? They don't
No,
ski
no,
they stayed
it
home.
wasn't with my parents. No, they are 80 in the 80s.
Okay.
So
I went skiing with my dad at 80.
Okay, no, my parents are not that fit anymore.
Yeah.
No, but we went skiing with my son and a friend of him, and we went to Flims.
Nice.
And had a really nice skiing week. Yeah.
My dad is 92, gonna be 93 in 2 weeks, and he still wants to go, but I don't want to go anymore.
You don't want him. Okay.
I'm afraid that if he falls,
I would like to be that fit.
I think now he's become more reasonable.
But you have nice alternatives, right? So in order to avoid my son stopping me skiing when I'm 80, 90, you can, instead of downhill skiing, there is cross-country
skiing.
You can do snowshoe.
Do you cross-country ski?
Yes, I do. I started a couple of years ago, and I like it a lot. So maybe I should switch because maybe
healthy.
Yeah.
Healthy. I prefer just
and
going
less dangerous.
Sounds good. So good start for 2024. Before we go into maybe looking into 2024 and looking ahead, I really look forward to doing that with you because you always have so many interesting points that I haven't thought of. But let's look back first to 2023. Like if you look back to that year, what were like the things that really at this point, maybe one or two things that just stood out for 2023 as you look back?
One is definitely the increasing polarization in our society, also in the US. I mean, now it's election year, so we will see more of that. But I think that's important, that in polarization, I mean, there's more wealth polarization and more political polarization, and both have implications. The wealth polarization means that you can measure it by the Gini coefficient, for example, is that, if we take a look back even to 2020, the year with the pandemic, I mean, where 95% or most of people lost money, there was a small elite who made money. And that's a trend that continues. So to put it easy, the rich get richer and the poor get poorer. So that's a development which is not good also for stability, right? It's not just good for justice, for even society, but it's also not good for stability because that creates tensions, right? And the same is with the political polarization. I mean, the political polarization in the US is as far as now as high as never before, and there are also different ways to measure it. But each party, the Democrat, the Republican, they have strong support, the highest support for their candidate, and almost zero support for the opponent. And in a way, in an extreme way, it has never been before like that.
Yeah, we in the special report, the last one, we actually had a map, and we can maybe show it here, that showed the world map with the Gini coefficient, and it was quite striking to see that the U.S., the darker the color was, the greater the problem was of polarization, reflected in the Gini coefficient. And I mean, the U.S. was up there. There was like, if you looked at South Africa, that part of the world was the most extreme, and then you had Mexico, and the U.S. actually looks very similar. So that's a problem, and I think I would agree that if the U.S. economy, both in terms of the U.S. Political and economic leadership, if they have that kind of polarization politically and economically, it's an issue for the world, not just for the U.S.
It's an issue for the world and also for stability, right? Just think about it politically. I mean, if politics is centered in the center, then you don't have huge changes coming with each election, right? But what we could see now is that each time the ruling party changes, because politics are so driven by the extremes, that the new government might reverse a lot of the decisions made before, and that creates uncertainty, which is not good for a country, right? So
you actually sent a chart, which I thought on that topic was really interesting as far as the political polarization goes. It's interesting. On this chart, what we see is actually that this polarization did not start with Trump. It's most extreme now with Biden. It actually started also already under Obama.
I mean, and we have to be honest, right? I mean, we have in Europe a similar situation. I mean, the polarization, it's not between two parties, but it expresses itself a little bit in a way that we have a multi-party system, and what we see is new parties or smaller parties coming up, winning a lot, right? And the established parties losing a lot of the backing of the people.
Which is good in a way, right? Because the pendulum has to swing back. I mean, on some topics in Europe, I mean, the topic that you and I discuss a lot is energy, for example. I mean, the Germans, I'm sure that with your dad, when he visited with you, there was talk about German policy and what's happening in the German economy and politics. I mean, that's even worse to some degree than the U.S. It's really, Germany is going down a very, very bad path, and that's bad for Europe. I mean,
yeah, I mean, it's the big difference between the U.S. and Europe. It's the U.S. It's energy self-sufficient, more or less, and Europe is not, right? And with the decisions being made concerned the climate and reducing CO2. That means, of course, much higher energy prices in Europe, and Germany, as an industrial country, relies on cheap energy for their products, for their services. And no, I mean, yeah.
What they did is they turned off their nuclear plants in
That
April.
was a nightmare. I mean,
last year in April, they actually went through with that, where I thought they're not going to do it again.
No, it's
but
really,
they actually did it.
They did it. It's ridiculous. I think
so
it's more or less the only
Germany
country.
has no more nuclear energy at this point.
They shut it all down.
So where are they getting? I mean, because wind and solar is not going to be sufficient to run Germany. So where are they getting that energy?
They have to import it, and they have to import it from other nuclear power nations like France or from Eastern Europe. And also Germany burns as much coal as they didn't do for decades, so the CO2 emissions are almost at record high. So it's.
I think they reactivated brown coal.
Yes, they had to, because they have to make up for the loss of
which
nuclear
is the worst.
power.
I mean, also for air pollution, that is
Absolutely.
like the worst.
It doesn't help the climate, and it destroys the economy to a certain degree. Yeah, so it's not a win-win. It's a lose-lose situation.
Right. Let's not spend too much time on that yet. I mean,
no, but
first,
maybe if I interrupt you, because just talking us about nuclear energy, that's a huge change, isn't it?
It is.
Because until 2 years ago, if you mentioned the word nuclear power, it was like, no one wanted to talk to you, right? And you were treated like an alien. And that's also you were asking for.
Yeah, you're right. And that was actually in 2023. That was another element which was a bit of a game changer.
Exactly.
Right? So.
You were asking me for game changers, and what we saw is that in 2023 we had a global change of the perception of nuclear energy. I mean, it seems to be now that the whole world, it's going nuclear, right? And I think that's also related to that there's some phase of realization concerning the energy transition.
The other thing that stands out, but I'm always kind of drawn back and forth between 22 and 23 looking back, you know, certain things started kind of in 22 when it comes to, for example, you know, obviously the Ukraine war and weaponization of the dollar and so on. That goes back to 22, but it has carried into 23 in terms of politics as well. But the thing that maybe we can touch on also is the inverted yield curve. I mean, that's one thing that strikes out to me, at least, that inverted yield curve is still there. You know, it's like in the past, you had those yield curve inversions, but they were quite temporary. And this one's quite sticky. Just to explain the yield curve for those who aren't, when we say inverted yield curve, it's quite simple. It's, you know, if you look at yields on fixed income, on bonds and treasury bills and so on, you would expect longer term bonds or creditor obligations to require higher interests. Because as you go further out into the future, the risk rises that you may not get paid back on your debt. And so usually short-term interest rates are lower than long-term interest rates. That's different now, which is a very unique situation. I don't know if you want to explain a bit how that came about. You know, it's because it was actually also a problem. Some of the banking crisis that we saw early last year in the U.S. and which was, you know, also led to Credit Suisse, you know, being involved to some degree. Were other reasons, had a lot to do with the inverted yield curve, actually.
Yeah, I mean, it's inverted yield curve. It's not the natural situation, as you explained, because you want to get compensated for the risk you are taking, and the longer you depart from your money, the higher the risk is. So that's an unusual situation. It can have different, you know, causes why yield curve is, you know, inverted. There is the central banks play around, so it's
play around.
They play around. They can manage to a certain degree the yield curve, but what it's clear is usually in the past what we have seen for whatever reason the yield curve was inverted, it was always, or in most cases, before a recession was coming. So and that could also signal what we expect or what we can expect for the economy. I mean, it goes hand in hand also with the very low economic growth expectations. Just numbers came out from the World Bank, and on a global scale, we are just growing approximately a little bit more than 2%. That's very little. And even the engines of the past, I mean, it was China after the financial crisis in 2008. China was the engine before other regions had the engine. It's all gone. I mean, we have hardly any region growing more than 5%. The only big countries coming to my mind, it's India, maybe Bangladesh, but I think most other countries are below 5%. And that's not a lot, right? So the economic growth, it's going down. So it's just a little bit above 2%, but it's really going down this year and next year. And in combination with, you mentioned the Ukraine conflict, which started, but by now we have two more conflicts, or meaningful conflicts.
Right.
So we have the Israeli-Gaza conflict by now also, and just recently we have the Yemen conflict also starting. So we are going to a situation where we have a little economic growth globally. We have globally high debt situation, and we have increasing conflicts. So that's the reality we are going into.
Yeah. We're in a phase that is, you know, there's great change at the geopolitical, at the political level. There's a lot of turbulence going on. Economically, I think we haven't touched on that quite yet, but the whole situation also with BRICS and supply chains, you know, the Ukraine war to some degree was a changing point there too, that the way the world was structured with, you know, a clear kind of leadership situation by the US with Pax Americana. Now we're in that recalibration towards a bi or multipolar world. All of those things are things that investors and any citizen really in the West and everywhere should be aware of, and should understand that those are big changes, and those are tectonic changes that will not go by without an effect on the global economy and the financial markets.
No, I agree. I mean, and it seems to be, I mean, they have been in place for quite some time, but it seems to me that they're accelerating, right? So with the emergence of China as a power, as a future superpower, we had this, going away from the US-centric world to a multipolar world before. But for me, with the Ukraine war, there was one incident I think that is accelerating these developments, and that was the freezing of the Russian assets. I mean, when the Ukraine war, it was relatively
Yeah, some people talk about the weaponization of the dollar, which was really a huge fumble by Biden, in my view. I
it was a
think that was
fumble,
shooting ourselves in the foot. And I
and
say ourselves because it's Americans and Europeans, I think, are
absolutely, it's
shooting
firing
themselves in the
back.
foot.
It's backfiring already, and what was happening? Just when the war started, it was relatively quickly decided to freeze the Russian assets in the West, and we're talking about.
I think they also tried to keep Russians from, or Russia to be able to use the SWIFT system, right?
Both.
So it was really both.
Yeah, both. But they have used the SWIFT system, so being able to use or to execute US dollar payments before. That wasn't the first case. I mean, the US did that before, but on what happened with Russia is on a large scale the freezing of a huge amount of assets. And I think that's a key point, turning point, because we're talking about 350 billion US dollar. It's a lot, and they just read that just the assets in I think it was in Luxembourg or somewhere else, they produced last year 3 billion in interest rates. So we're talking about big money. But what happened with the freezing of these assets, I mean, it was clear to everyone outside of the Western Alliance that their US dollar assets are at risk. So if they don't do what the US expects them to do, they might be lose, or their assets might be gone as well. So that led to a situation that countries like China and India and Brazil, they start to think about, not just start to think about, they already buy less US dollar, and they want to get away of the problem being blackmailed by having huge US dollar assets. So, and for the US, that's a problem, right? Because the US, it's a chronic account balance deficit nation. So it's a debtor nation. And the US needs the financing. So by freezing assets from one of their creditors, it's their scaring off their debtors, right? Their creditors. And that's, as a debtor, a bad situation, right? Because the US needs financing their deficits. They scared off the Russians, but now also China and all the other big nations realized the risk they have with the US dollar. So in my view, the US dollar will, for the near future, definitely stay the world reserve currency. I mean, it's the most liquid one, it's the most accepted one globally, but they have lost the trust in it, right? So as a world reserve currency, people have trust in it, or have to have trust in it. This is why China, the Chinese renminbi or yuan, and the Russian ruble cannot make it to world reserve currency, because there is not enough trust and law and order and so on in that system.
There's a lack of alternatives still, but it has accelerated the fact that the will or the motivation of, let's call it BRICS countries, to wean off of US dollar dependence and leadership has been accelerated.
Yeah.
So looking back, I think, again, there's a few things. So we mentioned debt, the inverted yield curve, fiscal central bank policy, which obviously led to those things. Polarization, one positive last year, finally nuclear. But overall, let's kind of think about now, what do those things mean for the future? So if you look at that situation, what's your outlook for 24 and beyond? Maybe first more the shorter term in 24. I mean, it's always hard to forecast, but last year kind of was a year surprising us, at least in financial markets, to the upside. Next year might be a surprise to the downside for a lot of people, I guess.
Could be. Last year, you are right. I mean, that wasn't a surprise to the upside, because we had the most aggressive rate hike cycle for decades, I think, in history, but at least for decades. And that's usually not good for stock markets, right? So rising interest rates are supposed to be negative for...
Well, they did start to level off a bit, right? I mean, inflation came back. You know, I think you're now looking at, is it 3.5%? You know the numbers better than me, Dirk. So you have had some of that. So that, I guess, was positive for the markets, because people were, you know, the markets hoping that, you know, maybe the Fed will start reversing, right?
Yeah, but it does. I'm not so sure about it, because inflation came back, to the 3% level, but it's starting to go up again, right? So we have to see if
there's certain factors which may drive it back up again, is what you're saying.
I could easily see a second or third wave of inflation, as we have seen in the 70s. So there are certain factors. We have a situation that commodities, the price of commodities heavily affects the price of everything else, because that's the beginning start of all production and services. And there's a huge chance that commodity prices will go up, which could bring inflation up. Secondly, with these crises we have mentioned, it's also inflationary, because what we have seen is now with the Red Sea situation and with the Yemen conflict, that already 20% of global shipments are affected by that. So it takes more days, because you can't go the shortest, the quickest route anymore. With your ships, you have to make detours. It takes longer. It costs more. So that's inflationary. Also, we have supply chain interruptions already starting. So what I read, that the Tesla plant in Germany cannot produce anymore, because or parts are missing again. So we see it's a little bit of déjà vu with the pandemic. So we have to see how it plays out. But each crisis, each conflict has also inflationary potential.
This recalibration of the world order, you know, is not to be underestimated. I mean, in that special report, we wrote about the fact that we think inflation and interest rates will stay elevated or be stickier than most expect. And then there's a lot of reasons why more of those factors will come about. So that's your point, is that you don't think that you actually think it will be, as in history, as we've seen, inflation can be quite erratic. You know, it can come back. So you just compare it to the 70s, you know, you actually had a situation, I think around 75 or so, where suddenly then inflation started, you know, was actually coming back. And then it went up way high into the 80s, until finally Jimmy Carter brought in Volcker to take care of business. And that was very painful, but that was then the final turning point for inflation. And if you go back to the Weimar Republic situation,
same. It was in waves.
You can't really calculate. Things happen in waves.
It happens in waves, and I would expect next waves coming too. So I think we shouldn't bet on inflation stays where it is. And as you mentioned, I mean, even if inflation, you know, comes back from 6 or 8% down to 3%, prices are still much higher. So it's not that in order to bring prices back to where they were, we would need negative inflation, and we don't have that. So the price level is already elevated, and I would expect another inflation wave. I mean, there are also other reasons, right? So if the Fed at some point, you know, if the economic situation requires the Fed or stimulates the Fed to ease the financial conditions and more or less to print money again, right? That could be also inflationary. Then we have a generational shift in the workspace. I mean, we have pressure on wages, right? And the reason is that the baby boomers retire, and not the same quantity of people joining the workforce at the same time.
Worldwide, we see a slowing of growth, but we do still see growth, you know. And I think the charts that maybe we can then show, it's kind of levels off. Currently, the forecasts are kind of level off at like 11 billion people. But in the West, obviously we have shrinkage. So you're saying that will provide pressure on wages and inflation.
Yeah, absolutely. I mean, the growth, population growth, as you mentioned, we have, it's not in the Western world, it's mainly in Asia, in Africa, in Latin and South America. So, and that puts pressure here, right?
Really, I mean, it puts pressure in the West more than it does actually in those BRICS nations. So that bloc actually has its own issues. I mean, China has huge issues, and one of the biggest issues is that it's becoming more autocratic again, which is hopeful for us in a way because that system will fail. But what you see, I mean, one of the charts I think we showed in the past is where you compare the amount of trade that the U.S. did in maybe 20 years ago versus today, where the majority of trade is done with China worldwide. And that picture, we'll put it up, is a picture I think that is an eye-opener. You know, the world has become more Chinese. And I think it's valuable for us in the West to really understand that and what the implications are.
Yeah, we don't have the leverage on the rest of the world that we used to have, right? I mean, there's an alternative. In the past, it was the West, it was the US, and it was the Western alliances. But and the rest of the world didn't have a choice, you know, to team up with if they wanted to prosper. But with the emergence of China and now with the emergence of the BRICS states, there's a real alternative. And we just had the BRICS expansion. And if we think about it, I mean, Saudi Arabia is one of those countries. I mean, Saudi Arabia, it's a clear signal on which side they stand, right?
Dirk, did they actually go forward with trading oil in non-US dollars? So the petrodollar deal is dead.
The petrodollar is dead with them. Wow. And they took a side, right? And by joining the BRICS, joining the Russians, the Chinese and the Indians, it's a clear signal. And it's commodity-wise, as you mentioned. I mean, it's the BRICS, after the expansion of the BRICS countries, they have approximately 3.6 billion people on their side, on their alliance. The G7, to the contrary, the West Alliance, we have 750 million. So it's really, it's not that we are the big superpower, the only big superpower anymore. I mean, it's from the GDP, it's almost equal, depends how you measure it, if you measure it in US dollar or by purchasing power parity. But let's say, you know, both blocks are equal, but they have the majority of the people globally. And specifically now also with Saudi Arabia joining, I mean, they own the largest resources, specifically in energy, in oil and natural gas. So it's our leverage, which we had in the past, it's gone, right? So we have to,
or at least it's decreasing.
It's decreasing, so we have to face that situation.
So it's we're seeing those things. So these geopolitical tensions, you know, a reordering of the world. We have the problem of huge debt. I think World Bank just came out with numbers where I think total world debt compared to GDP is over 300%. That's unique. And the global economy is actually slowing. I think the numbers, the growth is not what it used to be just a few years ago. So there's headwinds that we're dealing with. So looking forward now is, I guess, talking about what are the implications, or, you know, what's the outlook for our clients, you know, for investors.
I mean, as we just discussed, the overall situation doesn't look too rosy. So I wouldn't expect necessarily the stock market to do as well as it did last year. I would expect more volatility, more uncertainty, but it's pretty sure that there are always good investment opportunities, right? But you find the good opportunities today in different areas that you might have found them 2 or 3 years ago, right?
So if you could pick, like, I don't know, 2 or 3 core themes that we currently, you know, think are to be prioritized in an overall strategic allocation, what would those themes or sectors be in your view?
If the overall business cycle doesn't look too good, you have to look for opportunities for business models that are less dependent or completely independent of the current business cycle. Just to give you an example, I mean, if we are just talking about the crises we see with wars and larger wars, smaller wars. I mean, the defense sector, the security sector, it's not based, it's not doing good and bad in correlation with a normal business cycle. It's a different cycle, and the cycle is: do you expect more uncertainty, more conflicts? And we are in such a situation, right? So the outlook over the next 5 to 10 years, I would say that I would expect more conflicts, more crises as a country, and I would like to be prepared. This means we have to invest more in defense technology, right?
So defense, cybersecurity.
Exactly.
But then also because of inflation, you would probably see prices for commodities although the economy is slowing, you might still have an impact. What's your expectation on commodities?
I'm in general very bullish on commodities for the next 5 to 10 years, and that has mainly two reasons. The first reason is that in general, real assets, they give you relatively good protection in inflationary times. That's historically proven.
I think we wrote an article on that a while back. Also the fact that we've now been, over the past 40 years, with lower and lower interest rates overall in the West, or globally actually. It was an era of financial assets.
Yeah.
And now we're kind of going into an era of tangibles because of the fact that now we're going into the counter move. So relatively speaking, it doesn't mean that, financial assets cannot be invested in, but relatively speaking, overweighting into tangibles and real assets is also a topic that we have an eye on.
Yes, the ratio between real assets and financial assets it's low, right? So commodities, as I mentioned, it's very attractive from the inflation point of view, that it should give you some protection, but also from the point of view that we have a very special supply-demand situation, or supply situation. Let's first put it that way.
You actually mentioned the other day copper.
Copper.
They haven't. I mean, there could be a lower supply because they're not discovering anymore.
Exactly.
I mean, there's
Because over the last 10, 15 years, we haven't spent almost any money on exploration activities. Exploration means, commodity business is an extracting business, right? So it's gone. What you're taking out of the ground, it's gone.
When you say we, are you talking about the West in particular? Because I feel like, why would China or Russia stop exploring? Because they're not, the screen ideology that we're in the West really mostly subject to, that doesn't really exist.
It's mainly the West, but it affects the rest of the world, because much of the exploration, also in the non-Western countries, it's done by Western companies.
That's a good point.
So, and what I can see...
the big mining firms.
The big mining firms, they and the oil companies, they do exploration and drilling.
So they've
globally.
invested less in that area.
They have, and they couldn't do so, right? So, I showed you a chart. It was copper and it was gold, and you can clearly see that the last 10, 15 years, we have hardly discovered any major projects, copper projects or gold projects.
Gold as well.
Gold as well, and oil as well. Since 2008, 2009, these discoveries fell off a cliff, and it's gone to zero. So we are living off the past, and we are running literally out of the commodities ready to use. It's not that we have a global shortage of copper in ground, and it's not that we have a global shortage of gold in ground. But the importance here is that it takes 10 to 15 years from exploration to production, and we are facing a shortage. So this is why I'm also very bullish, because regardless, the question is,
And commodities have been quite suppressed, across the board. Some of them, quite a few of them have been quite suppressed if you look at the index, right?
Exactly. And those prices haven't, why didn't we do any exploration? Because prices have been so suppressed over the last years or decade. But on top of that, it was for most mining companies or energy companies, it was impossible to get funding from banks because of the ESG aspect. So it was getting funds for drilling, for mining, it was a no-go business. So no, with the commodities, that's interesting. even in a recessionary type, because usually the counter argument is, why should copper do well, or why should oil do well?
If we're headed for a recession.
If we go for a recession. And that's true. If we wouldn't have supply issues, in my expectations, we will see for many of those commodities, even if we go into a recession, which might mean less demand, I would expect the supply side to go faster down, so that prices will go up even in a recession.
So, as far as sectors, energy, commodities, defense, cybersecurity. I think also automation and robotics to some degree we're interested in. Now, what's interesting though is that in general, we've been discussing, we're gearing much more towards, or less towards certain stocks or certain sectors that actually were very strongly influenced by growth stories. Obviously last year I think there were like 7 stocks that really kind of made the market. Our focus is clearly on financially strong stocks within those sectors and other sectors at this point. Again, kind of gearing up and protecting against where we think we're going to see maybe some more difficult times in financial markets.
Absolutely. So our focus is actually on themes, on sectors where we expect over the next 3 to 5 years, I would say.
So value more important than growth at
Absolutely.
This point.
An outperformance against the overall sector, and more or less also a little bit independent of what I mentioned, the business cycle in general. And with the uncertainty and maybe the weakness, economic weakness ahead, for example, value. I mean, value also includes for me that sound balance sheet, right? So companies, they need a buffer to also to go through some hard times.
So companies with a strong balance sheet and a buffer to survive difficult times.
Not just to survive, if I may interrupt you, but those companies
might even thrive.
Maybe thrive and take over, the ones that are suffering haven't been prepared the right way. So there will be huge opportunity. I mean, even if
Now those stocks, maybe just to explain our approach to that, I mean, those stocks too will suffer from financial market corrections.
Yes.
However, we believe that you can currently buy them in a relatively attractive price range compared to some of the growth stocks that have kind of outperformed everyone. Maybe, I don't know if you want to describe a bit our approach to downside protection then, because that's an important element of, and you're a big proponent of that, even though we know downside protection doesn't work in all phases, but at this point we're actively doing that.
Yeah, downside protection, I would put it as a risk management. And what does it mean today? I mean, as we expect some difficulties ahead, risk management matters. But risk management has different aspects, right? So it starts with the right asset allocation, asset class allocation. I mean, that's really, how much stocks do I really want to have? How much bonds do I really want to have? How much commodities and how much alternatives? So having the right setup with the asset classes helps a lot, right? That's risk management. Then within the equity part, for example, we don't think that the general market, the broad indices will do well for the different reasons we mentioned. We think that,
and when we say that, just to qualify that a bit or explain it, it's, I mean, if we look at our most probable expectation or forecast scenario, I guess, we're thinking of a kind of a muddle through or stagflationary situation, which really requires that, like you just said, not everything's going up. It's not a clear trend situation, which really also means that investing is a bit more difficult in this phase, and chasing beta will be a bit more difficult. Another aspect that we'll touch on in a bit is also the fact that private markets are becoming a bit more interesting or important as public markets actually become less frequented. I mean, you actually see a lot less IPOs. You actually have less choice in public markets. So that's a whole other topic that we can definitely talk about. But when you're looking on the on our scenario, we're looking at more of a stagflationary scenario with the lowest probability actually being a scenario that is a soft landing or like somehow a sudden burst to the top. We don't really expect economies to surprise us on the upside, whereas there's quite a few black swans, if we want to call it, on the downside. So that's kind of our big picture right now in everything we've discussed. So investing in that, what you're saying is risk management is important. Risk management comes at different levels and dimensions, ranging from your overall strategic allocation and then within each asset class, making sure that you take the right decisions, value investing over growth in stocks, and then downside protection, even so far that certain parts of our equity allocation we actually protect with put options, even though that costs money. That's an insurance that costs money, but we do that quite actively at this point. What about bonds? What's your outlook on bonds at this point? I mean, right now it looks like at least some bond exposure could be interesting because interest rates might actually still come down a bit, but that would be a temporary play in our book right now, right? So we wouldn't go into long-term bonds at this point.
No, with our view, which you were just describing, I mean, inflation could come back, interest rates might go higher. We have reduced our bond positions anyway over the last years, and the bonds we have, I mean, we have some of the bonds, but it's shorter term maturity, and that's it, So for the mid to long term, I would be very skeptical towards bonds, and I could easily see us at some point in the future, maybe in 1 or 2 years' time, that we don't have any fixed income exposure at all.
So basically, if the outlook is that inflation will be sticky and may actually rise again, it will be very difficult for the Fed to actually reduce interest rates, which means that rising interest rates could be on the horizon. Maybe short term, we'll have a bit of a slump in yield, which could help. So maybe tactically, but in the long term, if interest rates go up, the value of your bonds is gonna drop. How concerned are you on a more structural or systemic level if interest rates go up when it comes to another debt crisis?
Yeah, I mean, that's hard to say, but that's on the table, right? I mean, we discussed a little bit earlier that we live in a world of debt. I mean, debt levels have reached highs we haven't seen for decades. So rising interest rates puts pressure on governments, puts pressure on companies, puts pressure on individuals. So that could be a credit event, right? So if we go into high inflation again, rising interest rates, one thing we have to watch out is that a credit event could happen somewhere. A credit event means someone is not able to pay its interest anymore.
And there's a few out there already.
It's countries, it's companies, it's individuals. I mean,
and Europe is not out of the
not at all
out of the deep there, and the U.S. has to watch out as well.
Yeah.
As far as allocation, so we've touched on some asset classes. Outlook, I mean, gold. That's one that for us is pretty clear. Gold is something you need in your portfolio for hedging against potential crisis, but also investment-wise, just by the fact that there's several developments that are going on that may make gold also experience a lot higher demand, while supply, like you said, has not been. Exploration is a problem there as well, just like with copper.
Yeah, no, I mean, gold for me, we're recommending gold since I'm with BFI, right? And if you take a look back to the gold development, I mean, gold is hardly ever mentioned, right, in the investment news, in the news. But you know, in the year 2000, I remember gold was $250, $300. Today we are at 2,000, and I always hear that the comments that gold is manipulated and that they push the price down, and but if I take a look at from 250 in 2000 to $2,000 per ounce as of today, either there is no manipulation or they're doing a bad job, right? So it has had already a great performance so far, gold, and as you mentioned, there are many reasons to believe that this will continue.
I mean, especially in US dollars, right?
Yeah.
I mean, with our clients have done extremely well. The other part that I think our investors, especially U.S. investors, need to consider is the need for jurisdictional diversification.
Mm-hmm.
You know, the need to put a larger and larger portion of your assets in a jurisdiction where there's custodial safety, and we're talking about the typical Swiss private banks, where you have a strong business model that is safe and that also allows for privacy. And a lot of people think privacy is dead, but privacy is not dead. You know, there's certain reporting you have to do, but if you're really looking at protecting and growing your wealth for the long term, you want to work in a jurisdiction that has a tradition and culture of privacy,
Mm-hmm.
and that even from a digital standpoint, you know, one of the things last week we had a meeting, and I explained to one of our clients how important it is that in that case we're talking about a family office that we're not yet setting up, but are in the process of discussing with him and might set up. And for him too, it was I think an interesting learning point to hear that the way we do that is that, you know, if you have a family office is a strong concentration of information,
Mm-hmm.
right? Basically, a family office, a big part of that is consolidated reporting, making sure that you have a good overview of your different assets, of the performance across all those different asset classes and investments you have. And in order to do that, you need a lot of information, right? And so there's a concentration of information. Having the concentration of that information outside of your own jurisdiction, especially if the jurisdiction is highly indebted and maybe financial repression and wealth transfer is a growing problem, that's a smart idea. And it doesn't mean that you don't have to follow the rules of reporting and filing. That era obviously is over. But it means that you want to have that concentration of information in a jurisdiction and in a system architecture that has less exposure. We, for example, our systems, when it comes to sensitive data, is purely in Switzerland, and it's with any cloud information is with Swisscom, meaning that we have redundancy of data with, you know, the main server being in Bern, but then having backups in Geneva and Basel. So those kinds of things are things that people in this era have to think about as well. It's not just about investing, it's also about wealth protection. So maybe going back to the outlook on the investment side, I think are there any other asset classes you want to talk about? Or we did touch on private markets a bit.
Yeah, private markets. I mean, it's good. I mean, they're becoming more interesting one of the reasons is that there are more alternatives to get finance today, right? So where in the past, if you want, with a certain size, there was only the option, the IPO, you know, bring it to the markets, to the stock markets. Today, there are way more ways to get financed and more unicorns we have, you know, large companies over $1 billion are private companies. So they got financed a different way. And there are lots of opportunities in that space, and this trend might continue. So to have an eye on private markets, on private equity.
And alternatives overall, really.
Alternatives overall will become increasingly important.
Yeah, and we're definitely focusing on that more. One of the issues, obviously, with, let's say, private equity or private debt is very often the liquidity aspect of it, right? So it's structuring those things properly and investing in those things properly, and still, you know, retaining a certain level of risk management and diversification and liquidity is a challenge. So that's something everyone is dealing with. And so maybe if a summary outlook for 24. So what's in a few words, what are your expectations for 24 and then beyond?
I would say economically, politically, we will see some volatility, some tough times. Investment-wise, I see during these times huge investment opportunities and good performances.
Dirk, thank you so much. I mean, we talk a lot, obviously, since we work together, but it was still this was great.
Yeah, always great talking to you.